Hey everybody, Smart Silver Stacker here. I just have time for a quick video today, but I thought this was an important one to get out because it looks like bailouts are back. And it also appears as if the Fed may have already pivoted after a fashion. Of course, that's not the official story, but I'll tell you what I'm talking about here in just a moment. But first, let's take a look at some of the headlines we got today regarding these bailouts. So Credit Suisse, the troubled European lender, came under some pressure earlier this week when they announced that there was material weakness in their financial reporting in 2022 and 2021. That was an announcement they made in their annual report. And at the same time, the Saudi National Bank, the single largest shareholder in Credit Suisse, came out and said that they would not be offering any additional financial support to the troubled lender. But today, looks like Credit Suisse has secured a $54 billion lifeline from the Swiss National Bank. So if that's not a bailout, I don't know what is. Also, we had First Republic Bank. It's a distressed bank here in the U.S. There had been some significant fear that they would be the fourth bank failure here in the U.S. in the past week or so. But it looks like their share price is recovering after crashing after some larger banks have deposited funds to make them more liquid. Now, it's a bailout of sorts, I guess. It's not the government this time. It was JP Morgan and Bank of America and some of the other largest banks in the U.S. depositing these funds, but it doesn't look like there was perhaps some government incentivization, some government involvement here. So who knows what's going on behind the scenes, what kind of incentives the government is providing to these larger banks to provide liquidity to First Republic Bank. But the stock market sure did like the news of these bailouts. All the major stock indexes rallying today, all of them in the green. Gold and silver pretty much flat on this news, but they're holding on to their gains from earlier this week. And I do expect the metals, at least in the medium to long term, to be moving much higher as these bailouts become a more and more common occurrence. Now, if you're interested in buying some gold or silver, make sure you check out sdbullion.com. New customers can get gold or silver at spot at sdbullion.com/new. And another channel sponsor that I think you should check out is silverbotanicals.com. They've got a great line of personal hygiene and household products, all very high quality formulas made with natural essential oils, and they are powered by nano silver. Make sure you check them out with the link down in the description, and don't forget that you can use coupon code STACKER to save 10% on your order at Silver Botanicals. Now, the bailouts do seem to be back, but this is not the official story that we are hearing. In fact, it seems like the B word has become somewhat of an anathema to the powers that be, and also we are getting constant reassurances now from both the president and now most recently Treasury Secretary Yellen that the U.S. banking system is sound. There's nothing to worry about here. No problems at all. Forget the fact that we've had the second largest and the third largest bank failure in U.S. history within a period of a few days. Everything's fine. Janet Yellen, she used to be the chair of the Federal Reserve, and these Fed chairs, they kind of have a history of making these sort of absurd calls on the market during times of crisis. I mean, just look back to 2007 when we had then Fed Chair Ben Bernanke telling us that the subprime crisis was limited to subprime. It was contained. It wasn't going to spread. I mean, we all know how that worked out. And more recently, we've got Fed Chair Jerome Powell telling us in 2021 that inflation was a transitory phenomenon. We all know how that worked out. I mean, eventually, Powell was forced to tell us, that he's learned how little he knows about inflation. But anyway, when you hear the former Fed chair or the current Fed chair reassuring you about markets, you kind of know that the problems are real and that there's a real risk in these markets. And I think that there's really two takeaways from the events of the past week that we can all glean here. And the first one is that the financial system is not sound. It's extremely fragile. And if rates continue to rise, the financial system in the US and in the West in general is in a very precarious position. But the second takeaway, I believe, is that when push comes to shove, central banks and the powers that be, they're going to do what they need to do to bail out the system. I mean, that is the trend that we are witnessing as this contagion spreads and as these weaknesses in the system manifest themselves. I mean, look at the pace with which the Fed and the FDIC and the Treasury moved to bail out all of the depositors at SVB and Signature Bank. I think that they've really tipped their hand here, and they've shown that when a crisis manifests itself, they'll do whatever is needed to bail the institutions out and to prevent short-term pain. Now, the ECB today, this was an interesting headline. They actually hiked their benchmark interest rate by 50 basis points today. But, one thing that is going on in the EU is that inflation there is persistently high. It's even higher than we are experiencing here in the US. So maybe Christine Lagarde has decided to maintain the fight against inflation because it's getting so out of hand over there. And a lot of that has to do with the energy situation and the destruction of the Nord Stream pipeline, but also it has to do with the fact that the ECB had negative rates for some time as they were trying to, stimulate more inflation. That was what we were hearing out of them for years there, was that inflation wasn't high enough. Well, now inflation's very high. And despite the fact that they are continuing to hike rates at the ECB, I think the real test is going to come next week at the Fed's FOMC meeting, March 21st and 22nd. What are we going to hear from the Fed? That's the real question here. If we take a look at the FedWatch tool, currently markets seem to be pricing in an 18% chance that there will be no hike at all, no hike to the federal funds rate at the FOMC meeting next week, but an 82% chance of a 25 basis point hike. Now, I do think that markets are anticipating this correctly in the sense that there's probably no way that the Fed is going to do a 50 basis point rate hike next week. I mean, we saw how quick they were to respond to the crisis at SVB and Signature Bank, and I just don't see any chance of a 50 basis point hike. Now, if the Fed pauses the rate hike campaign next week, if we get no hike at all, that may very well be a confirmation of the fact that the Fed has pivoted. Now, I mentioned the Fed pivoting earlier in this video. What am I talking about? Well, I'm talking about this BTFP program from the Fed. This is the program by which they have agreed to accept these treasuries with unrealized losses from these banks in exchange for loans, and they're going to be taking the treasuries at par value, at face value. Now, of course, in reality, these bonds are worth significantly less than their face value. That's why these banks are having all these problems, because they have these unrealized losses. And in SVB's case, they were forced to realize that loss when they had to sell some of these treasuries to generate liquidity because of all the withdrawals that they're suffering. But this program, the BTFP, I mean, really, this is very much like a return to quantitative easing, if you ask me, because look at what the Fed's doing. They're accepting these treasuries, these distressed treasuries, these treasuries with unrealized losses that have this low yield on them at face value as collateral for loans. Now, first of all, this is obviously going to be inflationary because the Fed is taking these assets off of the bank's hands and they're giving them cash. Assets that the banks really couldn't sell because of the unrealized losses, and now they're going to have cash in hand. So this is going to have an effect on inflation. And also, just think about what QE is. QE is the Fed buying treasuries and putting them on their balance sheet. What they're doing now is they're accepting treasuries as collateral for loans at a value far surpassing the actual value of the treasuries. I mean, I don't know what's going to stop these banks from just defaulting on these loans and letting the Fed keep their crappy collateral assets that they don't really want in the first place and just keeping the cash. We'll see how it plays out, but it certainly seems like this is QE by just another name, and the fact that they're just issuing loans with these treasuries as collateral, it seems like really kind of a distinction without much of a difference between this and QE. And really, the problem with this return to QE by the Fed, by another name, and with these bailouts is that these are coming at a time when we are already experiencing very high inflation. I mean, according to the official CPI numbers, we're at 6% inflation year over year. The Fed has not been very successful in their inflation fight so far, and now they are bailing institutions out again. They've removed the FDIC cap. I mean, not officially. They haven't officially removed the FDIC cap on insurance, but for all intents and purposes, I think we can go ahead and say that all of the uninsured deposits out there are now insured when we see the depositors at SVB and Signature Bank being made completely whole, even the uninsured deposits. All of this is very inflationary, and this is going to be a huge problem because inflation is already very high. And ultimately, all of this additional liquidity in the system is going to have a big impact on the purchasing power of the dollar. Now, how long is it going to take before we begin to see this inflation? Because, there is a bit of a lagging between when the Fed creates liquidity, when they do things like QE, and when you actually see the inflation manifest itself in consumer prices. Just look at history. In 1917, 1918, the U.S. got involved in World War I. That led to a big expansion of credit, big expansion of the money supply. But you didn't really see the effects of that until the 1920s, when you had the Roaring '20s. And then we all know how that finished up. You had the Great Depression. That was the hangover to the inflationary high of the Roaring '20s. And then similarly, in the 1960s, you had the guns and butter economy. You had all this spending on the Vietnam War, all of this spending on the Great Society, the welfare programs that Lyndon B. Johnson instituted. And then you really didn't see the fallout of all of that spending and the expansion of the money supply and all of the deficit spending until the 1970s. We lost the gold standard in 71 when Nixon took us off the gold standard. He ended convertibility of the dollar into gold. And the 1970s were a very inflationary decade indeed, and that didn't stop until Paul Volcker got involved in 1979 when he cranked up the federal funds rate to 19%. Of course, there's no way the Fed can really do that now without completely collapsing everything because of the massively higher level of indebtedness and leverage in this economy. So, how long will this take to play out? Well, it's anybody's guess. I think that we could see inflation rising sooner than, decades from now or a decade from now, but it might take a little time to play out. But ultimately, the effect of this is going to be a drastic reduction in the purchasing power of the dollar. And I think it's going to mean some significant appreciation for the precious metals as well. And keep in mind that not only is this happening at a time of high inflation, but it's also occurring at a time of significant de-dollarization around the world, of geopolitical turmoil, of de-globalization, which is resulting in a less efficient global economy. And all of this spells a lot of trouble for the dollar's status as the world's reserve currency, and for its purchasing power. So as for me, I'm going to keep stacking, whether it's next year or months from now or a decade from now. Ultimately, I do believe that the precious metals, gold and silver, are going to be much higher. Silver remains one of the most undervalued assets in the world, and the fact that we can buy silver today for under $25 an ounce, I think, is a huge gift, a huge opportunity for us stackers. Of course, it's not financial advice. That's not what I do on this channel. I'm just telling you what I'm doing, but I am going to keep stacking. So let me know what you think about these most recent developments in the comments down below. Thanks for watching, everybody. Stay safe and happy stacking, and I will catch you next time. Smart Silver Stacker, out.